This is Matthew Kratter's Bitcoin University. Today I want to talk about MicroStrategy and convertible arbitrage. This continues our series on Bitcoin and MicroStrategy stock. And in this video, we're going to answer questions like, why are so many people doing apparently stupid things like shorting MicroStrategy stock? We can see that the short interest over time has moved from something like $1 billion back in 2021. Now it's over $8 billion. And if we take a look at the short interest as a percentage of the float, currently 13%, as a percentage of shares outstanding, 12%. So these are fairly high levels of shorting. We're also going to answer questions like, are conservative German insurance companies trying to get access to Bitcoin's upside in a sneaky way? I've been seeing a lot of posts like this one from Ryan Wilson. MicroStrategy, if you want to understand why this stock trades at such a premium to Bitcoin, in other words, to its underlying Bitcoin holdings, look at the customers for its convertible notes, its convertible bonds. Allianz bought 25% of the latest offering from MicroStrategy. Why would they do that? Because holding Bitcoin directly or via ETFs might be a bad look to insurance regulators. I don't think this is what's going on here. I don't think they're buying it to get exposure to Bitcoin or Bitcoin's upside. Instead, a quick Google search shows that Allianz does run a convertible bond fund. So I think this is why they've been buying MicroStrategy's convertible bonds. They're doing what's basically called convertible arbitrage. This is a market neutral strategy employed by hedge funds and other institutional market participants like Allianz. Market neutral just means you don't care if the stock or stock market goes up or down while you're holding the position because you hedge out that piece. The typical form this sort of arbitrage takes is you go long or buy a convertible bond, and then you short enough of the same company's stock to hedge the equity exposure, that embedded call option that is in your convertible bond. Now, this makes good sense from a corporate capital structure perspective, since if the company blows up, the bondholders always get paid off before the holders of the common stock. And so it makes sense to be long the bonds and short the stock because bonds are always senior in the capital structure while shareholders are always junior. So it makes sense to be structured along the bonds, short the equity rather than the other way around. So classic example of convertible arbitrage using MicroStrategy, you might be long the 2029 MicroStrategy convertible bond and then short the common stock MSTR against that. As we've discussed in previous videos, convertible bonds can be deconstructed into their constituent parts. It's basically like combining a regular plain vanilla bond with a very low coupon, usually 0 to 1%. In the case of MicroStrategy, they've been leaning towards 0% bonds because their stock is so volatile, they're able to price these. So you have the plain vanilla bond, and then you have this embedded out-of-the-money call option that allows you to convert the bond to shares of stock if the stock rallies to a certain price. This is what's called the conversion price. You can think of it as a call option strike price. Out of the money just means that the conversion price is above where the stock is currently trading. If you're finding this video helpful so far, I just ask you to help to support this channel's mission. Hit the subscribe button. That really does help this channel's reach and engagement. Leave a like, leave a comment, question, suggestion for a future video. Share this video with a friend or family member. Just a quick review here about what a call option is. Call option is a derivative instrument that gives you the right to buy shares of stock at a set price. This is what's called the strike price or the conversion price, for example, in the case of convertible bonds. The call option gives you the right to buy shares of stock at a set price before the option expires. In other words, before its expiration date. At the money call options, ATM call options, that just means the stock is trading right at the strike price of the call option. And this should not be confused with ATM stock offerings of the kind that MicroStrategy has been doing, which just means at the market stock offerings. This is something slightly different, though it does have the same acronym. So an at-the-money call option, stock is trading right there at the strike price of the call option. So for example, if the strike price of the call option is 100, in other words, that's where the person has the right to buy the shares of stock. If the underlying stock is trading at 100, we would say that this call option is an at-the-money call option. And out-of-the-money call option is the strike price of the call option is above where the stock is currently trading. So let's say, for example, we have MicroStrategy trading at $433 a share, and then there's an out-of-the-money call option embedded in their convertible bonds that has a strike price or conversion price of $672. That's above the stock price. So we would say that this is an out-of-the-money call option on MicroStrategy stock. And I'm not just making up these numbers. I'm basing them on a recent convertible bond offering that MicroStrategy did, offering these 5-year convertible bonds that had a zero coupon, 55% conversion premium. That means the strike price of the embedded option was 55% above the reference market price of the underlying stock. And so if the reference price of MicroStrategy stock at the time of this offering, at the time of the sale, was $433.55, the conversion price would be 55% above that. That's this 55% premium that Michael Saylor's talking about here. That would make the conversion price approximately $672, which is the same number that he uses here. So I basically backed in to this price, the reference price for the common stock. Now, when you buy this convertible bond, you're getting this out-of-the-money call option with it. You're also getting a fixed income instrument that allows you to get your money back at par or at the face value if the stock does not go up a lot. So let's see if we can dig into what this call option, this out-of-the-money call option might look like. We have the underlying stock price of about $433 per share. We have the dividend yield of MicroStrategy, which is 0. I'm using implied volatility of 150%, which is roughly where it's been for the 3 to 6 month options. You can use your own number for this. The strike price, as we said, is 672. And the expiration date of these options, they're 5-year options because it's a 5-year convertible bond. The expiration date of these options, of this out-of-the-money call option, would be December 1st, 2029. I'm just getting that from the bond offering, from the prospectus. And so if we price this out-of-the-money call option that's embedded in that particular convertible bond, we can see the price of the call, $388, etc. We can also see the delta. This is what's important. This is how much the call option moves. If the stock goes up $1, for example, the delta of that call option, it will go up 94.95 cents. So in order to delta hedge this call option that is embedded in the convertible bond, in other words, to hedge against movements in the underlying stock that affect the value of this embedded call option, in order to do this delta hedging, you need to sell short 95 shares of MicroStrategy for every 100 shares of stock that the convertible bond has the potential to convert to at the conversion price. So this is where I'm getting the delta is about 95, and that means you need to sell short 95 shares of MicroStrategy for every 100 shares that you're essentially long by holding that convertible bond. Of course, you're not really long those shares of stock, you're long this call option. And so what we're doing here is we're hedging out the delta of that call option to make the position, the combined position, the long convertible bond and the short MicroStrategy stock, to make them delta neutral so that the underlying price of MicroStrategy does not affect the value of that structure. If the delta were 50 or 0.5 instead of 0.95, you would sell short 50 shares to do your delta hedging. In order to remain delta neutral, the amount of shares that need to be held short will vary as the price of MicroStrategy moves around. So if, for example, you're doing this convertible arbitrage, you're long the convertible bond, and MicroStrategy, the stock, moves up, then the delta of the embedded call option will go up as well because you're getting closer to being in the money. And the probability of it expiring in the money is moving up. That's basically what delta can be viewed as, the probability of an option expiring in the money. But either way, as the stock moves up, as the common stock moves up, the delta of this embedded call option will go up. And so the convertible arb trader will need to sell short more shares of stock. If MicroStrategy moves down, then the delta of the embedded call option will go down. And so the convertible arb trader will need to buy back, in other words, buy to cover shares of stock in order to remain delta neutral. So we can see from this that convertible arb traders actually help to dampen the volatility of a stock rather than increase its volatility, because they sell when everyone else is buying and they buy when everyone else is selling. And this is one way that they profit through this delta hedging and really through their exposure to gamma. So how do convertible arb traders make money? They may earn interest on the cash proceeds from that short sale of the stock, their short MicroStrategy stock, and this, you need to subtract out the borrow rate. So in order to borrow the stock to sell it short, they need to pay a certain annual or daily borrowing costs, and that may be greater or less than the actual interest income they're earning on the cash proceeds from the sale of that stock after they borrow it. So this may be positive, this may be negative. In this interest rate environment, as long as MicroStrategy stock is fairly easy to borrow, I would expect them to have a positive interest income on this. They may also earn coupon payments from the convertible bond, though not in the case of this convertible bond, which we just looked at, because this one had a coupon of 0%. But if there's a coupon there, they will earn that coupon. but mostly these convertible arb traders profit from trading gamma. Now, gamma is a complicated concept. I'm not going to go into it in depth here. Gamma is basically the rate of change of delta, which itself is another options Greek that we've talked about. Gamma is the rate of change of delta with respect to the stock's price. And so if a call option has a gamma of 0.05, that means that the delta, not the price of the option, but the delta of the option, that particular Greek, the delta of the option moves up 5 cents for every dollar move up in the stock's price. So by adjusting the number of shares sold short, these arb traders can remain delta neutral and profit from gamma instead. Now it's important to note here, every trading strategy comes with risks. There's never the guarantee of free or easy profits. So what I've hoped I've demonstrated in this stock, at least what I believe is going on here, is that lots of people, it's convertible arb people who are shorting MicroStrategy stock, not because they expect it to go down. This is why we have the giant short interest we were talking about. They're short this stock not because they expect it to go down, but rather because they have this convertible arb position on where they're short the stock and long the convertible bond. Also, Allianz does not own MicroStrategy bonds because they're bullish on Bitcoin. In fact, Allianz owns MicroStrategy convertible bonds so that it can try to profit from convertible arbitrage strategies like the one that we've detailed today. They do not want these bonds to run and get in the money and convert to stock. Instead, they're almost certainly using it in their convertible arb funds. And this would make more sense as a diversification strategy across different hedge fund strategies for a very conservative shop like Allianz. At some point, they may want Bitcoin exposure, but at this point, I think what's happening is just they're trying to profit from the volatility. And MicroStrategy is a great instrument for this because it derives volatility from Bitcoin, and then it is able to issue these convertible bonds, which work really well for convertible bond arbitrage. If you want to go deeper down the options rabbit hole, I don't often recommend my old Trader University courses, but this one on options trading, where I go into all the Greeks, I go into implied volatility, I go into simple option strategies, covered calls, option spreads, as well as more complicated spread trades. I'll put a link to that in the description notes in case you're interested in checking it out. Be sure to use the coupon code YT as in YouTube, YT99 to get the best price. If you enjoyed this video, be sure to hit the subscribe and like buttons. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks all for watching, and I'll see you in the next video.